Hello, ladies and gentlemen. I hope you're fine wherever you are. I am the Acca tutor, your best Acca tutor online. Okay, online study. All right, which means you can study Acca on your phone or from whatever distance you are from me. Uh, that is, you might be in the United Kingdom, you might be in Pakistan, you might be in China, Australia, South Africa, DR Congo, and every place. Okay, don't forget the Kenya. Okay, they are students from that side, and we are so happy. We welcome you guys to our lectures. Okay, and as I have always uh, reiterated, you guys should be formal students. Okay, because after you watch the video, you need the notes to supplement as well as the exercises to do some continuous assessment so that you gauge your progress as you move towards the forthcoming exam. All right, so it is just my wish that you guys might consider this and formalize your tuition. Okay, without wasting much of your time, those are my credentials. I'm Jerem Chimkulu. Those are my numbers, and that's my email. If you feel like you want to talk to me or you want other services, extra services, like for example, you are somebody who is intending to be an Oxford Brookes University degree holder, and you want a registered mentor, I'm always available. I'm also available for that. I will take you through the mentorship process. So everything is sorted. I am a one-stop shop. So do not feel neglected or shortchanged. We are together, my brother, my sister, on the Acca journey. So without wasting much of your time, let me just get straight to the business of the day. Okay, now as you have seen here, we are only going to touch on these three basic accounting standards. Okay, International Accounting Standard number 38, that is intangible assets. International Accounting Standard number 10, that is events after reporting date. Okay, events after reporting date. And then if it's 15, that is revenue from contract with customers. Okay, so these are the accounting standards, the three accounting standards we are just going to discuss in this first video in our week 9 series. Okay, remember this is a week 9 series and we are touching a lot of things, we'll discuss a lot of things, and you guys need to just watch the whole video so that you won't miss anything with regards to this. And this video is actually useful for those studying the Acca paper of financial accounting, financial reporting, as well as the SBRI. You never know. You see, even if the content is a bit shallow for those who are doing the strategic papers, it gives the basics. Okay, the video gives you the basics of accounting, which you might need on your Acca journey, in as far as financial reporting or strategic business reporting is concerned. Okay, now in this lecture, three accounting standards, as I've already hinted, are going to be covered as we are seeing there. Okay, now let's start with the International Accounting Standard number 38, that is intangible assets. We need to know what intangible assets are so that we'll be able to differentiate them when we are confronted with an exam question about these assets. Okay, an intangible asset is an identifiable non-monetary asset, okay, without physical substance. So you can't touch an intangible asset, you can't touch it, you can't feel it. Okay, that's the main characteristic. Okay, and normally most of the intangible assets cannot be touched. They do not have the physical substance. Although these days there are some such assets, and as you progress with your financial reporting standard, you start to financial reporting modules, okay, or studies, you start to meet certain intangible assets which have got some physical substance. Okay, an example would be some athletes. Okay, athletes. All right, those soccer players. Uh, they are some form of an intangible asset to the football club. Okay, remember the Man U, the Manchester United, or the Juventus, or the Bayern Munich, or Barcelona. You guys, you can name them. Okay, they have got financial obligations. They produce financial reports, and those football players are recognized in their balance sheet as intangible assets. So you can see that to some point you can touch, you can feel that this is Messi, or this is Iniesta, or this is you can name all these players. Okay, Ronaldo, Cristiano Ronaldo, Sadio Mane. You can name them. Okay, we can touch them. Okay, they've got some physical substance, but we can't actually say we've got Messi or we have got Ronaldo in our balance sheet. Why? Because there are some certain rules that govern that says that you can't call a person your asset. Okay, you can't call a person your asset in the sense that you can't control them by the end of the day. Okay, but what we control on those people is not their personal. I mean, their bodies. We can't control their bodies, but we control the intellectual property. All right, we control. I mean, their services. Okay, their service is our asset. Okay, we recognize them as our asset. All right, so through it might be through some form of licensing, or simply just some intellectual property. Okay, that is it. Okay. I think I've said much on that. Just a recap. Uh, you see, when these football players are signed or are bought, okay, there is what is called a contract. Okay, they sign a contract with a football club. Okay, so it is the value of this contract, or the cost uh, that the business has made in procuring a player. Okay, so by the end of the day, the um, the value to the firm is what is now going to be considered as an intangible asset. But the player himself is a physical, is a person. Okay, it can be touched. It's got some physical substance. All right. So you will see that there are other forms of intangible assets that we need to know as we progress. All right. So in particular, the key characteristics of an intangible non-current asset are as follows. It is a resource controlled by the entity as a result of past events from which the entity expects to drive future economic benefit. So if we look back at the contract example, I mean the footballer's contract example, you can see that that contract is a resource to the entity. Why? Because it has got certain clauses that might influence this player to perform in the interest of the company, and by the end of the day, they start to get money. So from that contract, they will be expecting that the player will be contributing to their strategic objective. All right, there will be some economic benefits attached. All right, that's one characteristic. Then another characteristic is it lacks physical substance. As you can see, the contract itself might and is highly likely to lack the physical form. You can't touch it. Of course, the contract paper can touch it, but the contract, the details, the contents of the contract cannot be touched. Okay, so it is an intangible asset. Then it is identifiable and separately distinguishable from goodwill. Now, we understand as well that you will see that goodwill is also an intangible asset, but other intangible assets should be capable of being distinguished from this goodwill. Okay, so we need to see we need to be able to identify a separation between mainstream goodwill and other intangible assets. If we can't differentiate them between them, then by the end of the day, it ceases to be an intangible asset. But I mean, it ceases to be another intangible asset, but only goodwill. Okay, so we need to know that International Accounting Standard number 38 defines an asset as a resource controlled by the entity as a result of past events. The past events might include the signing of the contract. Okay, there should be a contract. You can't say this player is mine without the contract. So that the contract signing was the past event. Then, from which future economic benefits are expected to flow to the entity. If this player is there to just sabotage us so that by the end of the day we are going to be relegated, or we are going to be always performing poorly on the football pitch, then this player is not acting in our favor. Okay, we can't actually classify them as our own assets. All right, so this is the general. I'm just giving this football player example for you to understand properly or easily. Okay, now we need to also bear in mind these terminologies. Amortization. This is the systematic allocation of the depreciable amount of an intangible asset over its useful life. Amortization is another term for depreciation. Depreciation is normally used on assets or to assets where there is some physical substance. So the term depreciation is common in the International Accounting Standard number 16, that is property, plant and equipment, and other similar accounting standards. Okay, where they deal with assets with physical form. So amortization is a term used in relation to intangible assets. Then, when we are talking of the depreciable amount, we are simply saying this is the cost of an asset or other amount substituted for cost less its residual value. Then, when you are talking of useful life of an asset, this is the period over which an asset is expected to be available for use by an entity, or the number of production or similar units expected to be obtained from the asset by an entity. This is very important for your multiple choice or objective test questions. Okay, examples of intangible assets. We have got what are called development costs. We'll talk about them later. Goodwill, we discussed about this, but we are going also to talk more about it. Then trademarks. The trademarks, I'm sure you have come across, some time ago or once in your lifetime, about a Coca-Cola trademark. Okay, the Coca-Cola trademark. All right, these are some entitlements. Okay, legal entitlements attached to products or product ownership. Okay, or brand ownership. Okay, so you can't actually use that Coca-Cola on your own product. Okay, if you are not, given permission by the Coca-Cola itself. So the Coca-Cola is just an example. Then we've got licenses. Sometimes you might enter into a field which require you to have some license. Okay, for example, you might be a telecom operator and there is a certain technology you want to utilize in your own operations, but that technology, for you to use it in your country, you need to obtain the license from the technology owners. They need to license you to use that, okay, for your own business. Okay. An example also is on accounting software. All right, you need to have a valid license for you to be able to access the right to that software. Okay, so the licensing is also, remember, these licenses, there is some underlying I mean previous event of contract signing. Okay, for you to obtain the license, there is some you know previous event. Okay, remember our definition of an asset. Remember, it is a result of previous or past event. Okay, there should be some past event. Okay, so the signing of a contract, giving you the right or giving you the license. All right, patents. Okay, what are patents? They're almost like licenses. Okay, but uh, these are like some form of intellectual property. Okay, some form of intellectual property. Okay, so the idea of having a patent is that you need to restrict others from doing the same things as you are doing. Okay, so once you have the patent, uh, other people are going to be restricted, and you have the competitive advantage. Okay, so these are supported, almost all these, the trademarks, licenses, patents, they are protected by legislation. Okay, so the patent should be registered, and it will be registered in your name, which means that nobody is going to use without your permission. Nobody is going to use your patent. Copyrights are also other forms of patent. All right, but these ones now, uh, they, they they restrict other people to so they the copyright restrict uh, users, or they protect the owners. Okay, they protect the owners uh, from having their their products being uh, published. Okay, being published or given for public consumption without their their permission. Okay, what is the difference between a patent and a copyright? Okay, um, let us say, while okay, while the patent while the patent uh, let me just say, with the exclusion with the exclusion of design patent. Okay, design patent protect, while the patent, with the exclusion of design patents, protects invention inventions, okay, or innovations of new processes. All right, that's what normally the patent does. It protects uh, the invention of new processes. All right, all right. Copyrights, copyrights. on the other hand, protect copyright. On the other hand, they do protect published as well as unpublished works. Original works of an individual or company. So you can see that normally these trademarks, licenses, patents, they are all forms of intellectual property. Okay? But when you are talking of a patent, this one prohibits the formation or the invention of new similar processes. For example, right now, the technology about aircraft, okay? The technology about aircraft, the flying technology is subject to the Wright guys, the Wright brothers. Okay, I don't know if this one is the correct spelling for the Wright. The Wright brothers. These were the first guys to to establish or to invent the aircraft, the flying technology. All right. So whenever you are when you are constructing an aircraft or manufacturing an aircraft, you need to have this patent, the permission from these guys. You have to pay some certain form of money, okay, to get that right to manufacture an aircraft. All right. So the patent, the Wright patent, the Wright brothers patent, is there to actually protect or to prevent you from just claiming that you have just manufactured the aircraft without, copying their ideas. All right. So you would have copied from them because they are the first guys to establish that. All right. This is just an example. Okay. Then when we are talking of copyright, these ones now, they are usually associated with literary work, okay, literature works, and they are there to protect original works so that they cannot be copied without they shouldn't be copied actually in academic or professional context. Okay, you should not copy, but you can. Okay, when you happen to have a copy, you then have to follow those ethical guidelines about referencing and so forth. But copying word by word is not allowed. Okay, by the end of the day, when you take other people's ideas, you then have to recognize them. All right. So by the end of the day, you see this module is not about you knowing much detail about these intellectual properties, but you just have to have the basics. The idea is all those guys are patents. Now there is this animal called franchise. And franchising will be trying to use the name, okay, of a very popular brand, okay. So we wanted to penetrate a rather complex market, but we want to just penetrate that market with ease. Okay, we do not want to face some trouble in marketing and everything. We just want to just enter into the market with using a known brand, using a known name. So this excuse me. This is when the idea of franchising comes into play. Okay, so we'll be using non-brand, to enter a market. So we'll be using a non-brand to enter a market. Okay, but by the end of the day, you have to pay some money, okay, for the people to give you their brand. For example, you want to use the this KFC, all right? It doesn't mean that every KFC you're going to see, or every chicken inn, or whatever. Just an example. Doesn't mean that those are the actual guys, all right? But some might be, franchisee. Although these franchisees are bound to follow the rules of the franchise owner, okay? Yeah, but with the hardships of today, these franchise owners, they can't actually, they're not always able to come and do some inspections to see if you guys are doing what the McDonald's guys in London are doing. So you might discover a McDonald's shop in South Africa, or in Gabon, Botswana, or in Harare. Sometimes you discover that, oh, things are a hell lot of uh, unwelcome situation. So that should also ring a bell. Okay, it might be the fact that they are real McDonald's guys, but the employees are doing something, or it might be an issue of franchise. All right, franchises are not always bad or misused, but history has shown that they happen to be misused. Okay, now for the benefit of this exercise or this lecture, please appreciate that all these guys are intangible assets. Okay, they are intangible assets. The examiners won't be happy if you know the technical definitions of these guys, but not understanding the accounting part of it. The idea is, are you able to account for a trademark in the accounting records? Do you realize that a trademark, goodwill, trademarks, licenses, development costs are all intangible assets? That's the deal. That's the business of today. Okay? Now, let's talk more of goodwill. Goodwill is the excess of the value of business over the fair value of the net asset. And I'm sure you understand that net assets is equal to assets minus liabilities. So if the assets were, let's say, $1,000 and our liabilities were $600, then our net assets should be $400. Okay? Our net assets should be $400. But now, I do not want you to be confused and start to think that, goodwill is just net assets. No, it doesn't work like that. Now, let's say we want to dispose of the business. All right, we want to dispose of the business, and somebody has come and said, "Hey guys, give me this business. I'll give you 1,200." Okay. Now, goodwill in this sense would be 1,200 minus 1,000, this our asset, okay, minus the 600, okay, and you can see that this would be 1,200 minus 400. Okay, and you see that the goodwill would be 800. Okay, so in other words, In other words, we could have said this purchaser would give us 1,200, okay, and we separate the net assets of the business, and which were 400, and we are going to come at 800 as well. Okay, so we are saying goodwill is the excess of the value of the business over the fair value of the net asset. So the value of the business was 1,200, which the purchasers, the willing buyer, willing seller, okay, the willing buyer was ready to give us 1,200, which we also agreed to, okay, and our net assets were $400, so the goodwill is $800. Are we together, ladies and gentlemen? Now, there are two forms of goodwill. There is internally generated goodwill and purchased goodwill. Purchased goodwill is the goodwill which is allowed as an intangible asset. All right. So it is purchased in the sense that we would have purchased a business, an external business. All right. This is goodwill that arises when a company purchases another company. It is commonly the case that the consideration paid is greater than the fair value of the net asset, and this excess is the goodwill. This goodwill may be capitalized as a non-current asset and amortized. So it is capitalized as a non-current asset. To capitalize is to recognize in the statement of financial position as an asset. All right. Then non-purchased goodwill. This is goodwill established in the form of good customer care. You know, when we do good customer care, we end up having some customer loyalty and so forth. Okay, but such type of goodwill is not recognized in terms of International Accounting Standard number 38. An existing company is likely to be worth more were it to be sold than the worth of the net tangible asset. A company could therefore want to claim that there was an extra asset of goodwill. Okay, you can tell the audience that, okay, on top of the assets you are seeing, you have to put a 1 million on top because we are a good company, we are environmental friendly, we're just good to the environment, we are good to our customers, so we have won some loyalty over the years. Such type of goodwill is okay, but cannot be recognized. Okay, we cannot recognize that. All right. The idea is, even if you are claiming that if we are about to sell this business, we can fetch 2 million, you haven't sold the business, so we can't recognize anything. Please watch out for that. Okay, this one's not worth to worry much. The basic principle of recognition of intangible assets in the financial statement is when it meets the definition of an asset. The definition of an asset. Alright. So, by definition, the intangible asset should only be recognized if the definition if it meets the definition of an intangible asset and the recognition criteria of assets. Alright, remember there are certain recognition criteria attached to the recognition of intangible assets. Okay, and in particular, development costs. Although we have already indicated that goodwill should only be recognized if it is purchased. That's another criteria. Okay, so for you to recognize the goodwill in your books, it should have met the criteria of recognition. It should be from a purchase arrangement. Okay, when you have bought another company, that's when you have to recognize their goodwill, the goodwill on acquisition. into your books, and that goodwill should be subject to amortization rules. Okay, there are certain intangible assets, for example, development costs, as we have indicated, or as we have identified in our list of examples of intangible assets. We said that development costs were also an example of an intangible asset. So, although these guys are internally generated, they have to be capitalized. Okay, they are not goodwill. Remember, all right, they are not goodwill, and they are costs which are incurred in developing research activities. Okay, so they have to be capitalized, provided they meet the criteria. Okay, there is a criteria which we need to worry about. All right. So before we touch on the criteria, we need to understand, because these development costs are costs incurred in doing research activities. All right, they are costs incurred doing research activities. So we need to identify what is research and what is development. Research, this is the original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. Okay, while its development is the application of research findings or other knowledge to a plan or design for the production of new or substantially improved materials, devices, products, processes, systems, or services prior to the commencement of commercial production or use. So you can see that there is a difference, okay, between research and development. And you as an accountant, you need to know how to account for research expenses or research costs and development costs. All right. Now, the rule is research expenditure or cost should all be charged to the statement of profit or loss as an expense in the period in which it is incurred. So they are expensed immediately. Expensed immediately in the statement of profit or loss. So then and there, you just have to consider them as an expense. But development expenditures, with some exception, this should be capitalized and shown as an asset on the statement of financial position if and only if the following conditions apply. So these conditions ought to be observed. Okay, otherwise you should also expense them. If these conditions are not met, then the development expenditure should as well follow the fate of research expenditure. So let us see what those conditions are. The first one is there should be an identifiable product. Okay, just like an asset, we need to be able to identify it. This is why there was that clause that the intangible asset should be separately identifiable from goodwill. We should be able to identify that this is a separate product. The company should have the resources to be able to complete the development. Remember, development is an issue of upgrading from research activity into the final product. All right. So there should be some evidence that the company has enough money to complete the development. Let's say this is a company called Tesla. They want to manufacture a robotic car, okay, or a robot car. Now, during the process of investigation, they did the investigation very well. That was the research part of it. But now they want to develop this robot car into a real product. But midway, we discover that they no longer have the money, right? They don't have the money to complete the project. In that situation, we can't recognize any tangible asset because it can't be complete. There are no prospect that the company will have the money. So in that case, the expense should be considered as an ordinary expense. We can't capitalize that. then there should be an identifiable market for the product. The company should give us evidence that there is a readily available market, okay, or there is a potential that the robot car is going to be accepted by the community or by a certain market. Otherwise, it is just daydreaming and nobody's going to buy the robot car. Then, in that situation, we can't recognize an intangible asset. Then, the expenditure should be measurable. This shouldn't be just a dreamt about expense. Okay, you just can't claim that the expense we are going to incur is in high magnitude, or I mean, we can, if you can't measure it, okay, if you can't measure it in monetary terms, then the expense or the intangible asset cannot be recognized. So if there are no some quantifiable evidence that you are going to incur so much, or you have incurred so much, then we can't say you have got an intangible asset. Remember, the money measurement concept also applies. Okay, in accounting, financial accounting, there is what is called a money measurement concept, where the transactions should be capable of quantification. They have to be quantified. Now, if the costs are capitalized, then they must be amortized in line with the pattern of income resulting. Okay, let's say if this product which we have developed is to be there in the market for 5 years, okay, we are expecting cash flows over 5 years. All right, therefore we also have to amortize in relation to the cash flows, in relation to the time period of 5 years. Note that all the above only applies to intangible assets. If intangible assets are purchased, then they must be capitalized and depreciated as normal. Okay, so these rules do not apply to physical assets, and remember, these physical assets are accounted for using a relevant international accounting standards, for example, IAS 16 or IAS 40. All right, there are certain rules that govern those physical physical assets or tangible assets. All right, let's talk of amortization issues. All right, remember, these intangible assets might have a finite or an indefinite life. Okay, if the criteria laid down by International Accounting Standard number 38 are satisfied, development expenditure must be capitalized as an intangible asset. Talked about that one. If the asset has a finite useful life, it should then be amortized over that life. So when you are saying finite, we are simply saying the useful life is known. Okay, useful life is known. Okay, there is a certain or a definite useful life. All right, we know that. Okay, but when the asset has got an indefinite life, it must not be amortized. Don't amortize. Don't amortize. Don't depreciate. Okay, you must not amortize. Don't amortize, because this asset has got an indefinite life. What is an indefinite life? It simply means that you do not know when this asset is going to cease. Is that true with our football players? Can somebody say, there is this football player with an indefinite useful life? Obviously, at some point, they say Shirin or so far, something like that. At some point, the graph will go down. Okay, it happens, okay? It happens. But there are some intangible assets, for example, these trademarks or these patents. Some of them, they've got an indefinite life. For example, the Wright brothers, the Wright brothers I've just talked about, it's an indefinite asset, okay? Because aeroplanes are going to be manufactured and it's not yet clear when aeroplanes are not going to be used or are not going to be manufactured. So if you have got that patent, hey, yeah, you're likely going to recognize an intangible asset with an indefinite useful life. But what do you have then to do if you have got an intangible asset that has got indefinite life? You don't amortize, yes, we agree, but you have got a duty to do, okay? You should subject this asset to an annual impairment review. An annual impairment review, okay? Impairment. When you are talking of impairment, okay, this is subject to International Accounting Standard number 36, impairment of assets. And impairment is equal to a situation where the carrying amount of an asset is greater than recoverable amount. Okay, there is a I hope there is there is a dedicated lecture on impairment. Okay, but those who are doing the financial accounting paper, the Acca paper, not much about this knowledge is required. Okay, but you need to know. Okay, impairment is when an asset carrying amount is greater than the recoverable amount. And when we're talking of the carrying amount is the asset cost less accumulated depreciation. Okay, carrying amount is the asset cost less accumulated depreciation, right? We arrive at the carrying amount, and then the recoverable amount. Okay, the recoverable amount is the higher of the fair value less cost to sell and value in use. Okay, this is just for your revision, and you don't need it for now. You might not need it for now, especially for those who have studied the Acca paper, financial accounting. Okay, you might not need that for now. Okay, but if you're doing other papers, advanced papers, then you might need it. All right. So recoverable amount is the higher of the fair value less cost to sell. Let's say we want to sell the asset today. What do we get after deducting the selling cost? Selling costs involve the issue of the legal practitioners involved, some certain administration fees and so forth. Okay, those are the costs to sell. And then the fair value is what the willing buyer, willing seller, okay, is ready to give us. All right, we'll discuss more about the fair value in the parts coming. Okay, fair value is under IFRS 13. All right, we'll talk about that. All right, so at the measurement date, how much are we likely to fetch if we dispose of the asset? That's the fair value. And then the value in use. This is now an issue of in the remaining period. Okay, if we continue to use the asset, how much in cash flow terms are we going to get in terms of cash inflows? How much are we going to get? There should be some issue of discounting the net present value computations and so forth. All right, so those are the things we will be talking about. All right, and they also apply to our intangible assets. So if the criteria in IAS 38 are not satisfied, development expenditure must be written off in the period in which it is incurred. So if we fail to satisfy the recognition criteria, as we have just I talked about here. Then we need to expense whatever expense to the statement of profit or loss in that accounting period. Okay, let's now do some computation to send the point home, because by the end of the day, if we do not do some examples, I see somebody getting lost. Okay, I bet with my salary, there will be somebody lost along the way. So we don't want such a situation. Everyone should be right on track. So, ladies and gentlemen, can you try that question on your own? You can just pause the video and do it on your own, and then come back here for the exhibition. Okay, we have got this business which buys a patent for 50,000, and as I have indicated, these patents are bought. Okay, so this business has bought a patent for $50,000, and it expects to use the patent for the next 10 years. So the time is 10 years, after which it will be valueless. Calculate amortization of the patent and prepare an applicable journal entry in the accounting records of the business. Now, like I've said, amortization is the same as depreciation. Okay, in this case, you're given the number of years and the value of the asset, so you can use the straight line depreciation formula. Okay, so amortization is equal to the cost of the asset less any residual value, all divided by the number of years, okay, that is estimated useful life. The estimated useful life. So in this case, the cost was 50,000, and the asset was going to be valueless, which means the residual value was 0 all over the estimated life of 10 years. So each year we were going to charge to the statement of profit or loss how much? 50,000 over 10, that is $5,000 every year. Okay, so every year we're going to charge $5,000. So what about the journal entry? How do we record this? Journal entry simply means, how do you record? What type of double entry do you create or do you prepare? All right. So as I have already indicated, amortization is the same as depreciation when you are talking of physical substance assets. So in this case, we are going to recognize the depreciation for the amortization, which is an expense. Okay, so that's, we are going to debit expense amortization. Okay, we're going to debit amortization expense. Okay, that is the statement of profit or loss. All right, how much? $5,000. And what are we going to credit? Accumulated depreciation, accumulated amortization, 5,000. Sorry there, my pen. Okay, just 5,000. That's the journal entry that was required. Let us go to the next example. Okay, which of the following statements are correct? Number one, capitalized development expenditure must be amortized over a period not exceeding 5 years. Did we talk about this? Did we say the development expenditure should be amortized over a certain period? Did we say that? Obviously, this one is not. Okay, so in the exam, when you face this, you then have to use your elimination. Okay, just have to solve your problems by elimination. Obviously, any choice with a 1 is wrong. This one is wrong, so you're left with B and D. All right, In an exam under time pressure, you just have to use elimination, the principles of elimination to solve your problem. Problems disappear. They have to disappear. All right. For the purpose of learning, let us continue. Capitalized development costs are shown in the statement of financial position under the heading non-current assets. Yes, this is true. All right. This is true. They are non-current assets. Okay, those intangible assets are non-current assets. All right. Then let us now. So 2 is fine, but we have got B and D. They both have got 2. Okay, and there is also a 3. So we need to read 3 to see if we can eliminate that or accept that. So if certain criteria are met, research expenditure must be recognized as an intangible asset. Wow. This one now tests our comprehension. All right. We talked of development expenditure being capitalized, not research expenditure. Research expenditure should be expensed immediately when incurred. So research expense, this one is not okay. Research expense is not capitalized. So you can see that because of 3 is wrong. So our answer is D. All right, the answer is D. Okay, that's how we do it. All right, let's continue. Okay, so on this part, it should be the development cost. We should be recognized in the statement of financial position as intangible assets. All right, so only capitalized development costs are shown in the statement of financial position under the heading of non-current assets. Please get that right. Okay. There is this question here. Complete the following statement by selecting the appropriate wording from the choice available. Okay, when accounting for intangible assets using the revaluation model, movements in the carrying amount are now. If you have done or if you have understood our initial lectures, I mean, for those who have been with us in this course, I think in the second or third lectures, we talked of non-current assets and their depreciation and revaluation model. Okay, we talked of revaluation, all right, and we hinted that revaluation is accounted for in a unique way. You need to always remember that revaluation gains are recognized in OCI. The other component, the other comprehensive income. Okay, they are recognized in other comprehensive income section of the statement of profit or loss and other comprehensive income, or let us just say the statement of comprehensive income. Okay, the statement of comprehensive income, let me just find a space. All right, statement of comprehensive income, which is also called statement of profit or loss and other comprehensive income. Has got the profit section and the other comprehensive income section. Okay, the profit section starts with the sales. Okay, less cost of sales. Okay, and then we get what is called gross profit. And then we have got expenses, operating expenses. Okay, we deduct them from the gross profit, and we get the net profit. But we have got a section called other comprehensive income. Here we put some other income. Okay, other income, like for example revaluation gains. Okay, they are put in this section. So once you get that, you then have to get what is called total comprehensive income. Total comprehensive income, like that. That's what happened. Okay, so if you have got that background, you can easily slay this question. All right. So when accounting for intangible assets using the revaluation model, movements in the carrying amount are. Now, when you're talking of movements, ladies and gentlemen, revaluation by itself simply says that at a point in time, the asset is revalued. Let's say last year at 31st December. Okay, now my pen is not visible. Let me try to look for a pen that is more brighter. Okay, let's say at 31st December 2021 or 2020, the asset was $1,000, and then on 31st December 2021, the asset was now 1,500. The movement is the gain. Okay, the movement is the gain. All right, that is 1,500 minus 1,000, which is equal to 500. So the question is asking, where do we record that, or where do we account for that $500 movement? That's the movement. All right, that's the movement. So because amortization is the same as depreciation, the way you account for amortization is the same way you account for depreciation. So in depreciation, we say that the way you account for amortization with regards to physical assets should be the way you account for it with intangible assets. So the way you deal with depreciation to physical assets is just the same as the way you do with amortization to intangible assets. So if it was a physical asset, we would have recognized the revaluation gain in other comprehensive income. Therefore, we also have to account for this amortization, for this revaluation of an intangible asset in the other comprehensive income section as well. So this is how you do it. So you can see that A is our answer. Okay, the answer there is A. Alright, but it reads, you need to account for these amounts in the other comprehensive income section as well as the other components of equity. Now, you need to understand that usually what happens to the statement of financial position is also what happens in the statement of profit or loss is also going to be reported in the statement of financial position. So the other comprehensive income here, this section is for the statement of profit or loss, okay, and other comprehensive income, as we have just elaborated. All right, but this other component of equity is a statement of financial position section. Okay, it is a reserve. All right, it is a reserve that recognizes, or that where those other incomes accumulate. Okay, remember, the mainstream profit, the net profit, goes to a reserve called retained earnings. Retained earnings. Sorry. This is where the net profit goes. But other income goes to the other component of equity, which is the OCE. All right? Don't worry, you will reach there. Don't worry. When we are going to touch on this same week, or this same week series, we're going to touch on the group financial statement, the statement of financial position, the statement of profit and loss. You will see what we mean. Okay, you will see what we mean. Go. All right, but for illustration purposes, let's say our balance sheet is like this. We know that we've got assets. Okay, we start with the assets. The assets, we've got non-current assets as well as the current assets. I'm sure you remember this. Okay, we remember this. Then we've got equity. This is the statement of financial position, SFP. Okay, this is just a tablet. Okay, so we've got equity and liability section. This one was the assets. Then we start with the equity. Equity, all right, or share capital. X. Okay, we've got share capital. We've got reserves now, retained earnings. Retained earnings. We've got the other components of equity here. Okay, then we've got liabilities. Liabilities, we've got non-current liability, we've got current liability. All these should add up to a same figure. Okay, this figure here should be equal to the ultimate figure here. At the end of the day, that's the statement of financial position. It used to be called the balance sheet. The idea of balance sheet was to signify that the assets should be equal to liabilities. So it was the backbone of the accounting equation. The accounting equation, if you still remember, we said that in the accounting equation, assets is equal to capital plus liability. The asset is equal to capital plus liability. So this is the capital. Okay, this is the capital, and this is the liability, and these are the assets. So please always know these things so that when we move forward, nobody is going to be lost along the way. Okay, there is this example. There is this example, ladies and gentlemen. What is the correct accounting treatment for an intangible asset with indefinite useful life? An indefinite useful life is a life which has no known ending. Okay, the ending is unknown. Okay, so how do you treat that asset? A, it is recognized at cost for as long as the entity is the intangible asset. Well, this might be right, but not precise. So in the example, you put a question mark and go to the next one. It is recognized at cost and is subject to an annual impairment review. This is actually what we discussed. Okay, we say that you do not amortize an intangible asset with an indefinite useful life, but you have to subject it to an annual impairment review. We talked about that, so that B is actually clear and precise. Okay, C, it is recognized at cost and the entity must make an estimate of estimated useful life so that it can be amortized. The idea is not to amortize anybody or anything. Okay, so you mustn't cry for amortization. You mustn't pray for amortization. That's not it. So this one is wrong. Then it cannot be recognized as an intangible asset as it would not be possible to calculate an annual amortization charge. Again, this one is wrong. So you can see that B is clear and precise. So because of B, A is wrong. So this is why. So B is our answer. Okay, do we have another example? Identify whether or not each of the following items should be capitalized as intangible assets. So we need to see which one should be capitalized and which one should not. So let me try to look for a darker pen. Employment costs of staff conducting research activities. If individuals are conducting research activities, it doesn't necessarily mean that they are at the development stage or are still at the research stage. So this one, the salaries of those employees, these ones cannot be capitalized. Okay. So it's safer just say they can't be capitalized, okay? Because research activities or research expenditure, uh, we say that research expenditure should be expensed, so we can't capitalize it, okay? Remember, research and development are different, okay? Research is during that phase when we will be doing uh, the the investigation part of it. Okay, but when we are developing now, we are now moving from the research phase to development stage. Okay, although in industry, let me highlight the whole section that deals with the development and the research, the R&D, the R&D. So usually students end up being confused when they hear a term like research activity. They think that since development is also part of the R&D, then they end up being confused. But here, the main word, the watchword is research. Okay, research expenditure is or should be expensed as when incurred. Okay, what about cost of constructing a working model of a new product? Okay, this one now is an issue of development and should be capitalized. Then materials and consumables costs associated with conducting scientific experiments. Materials and consumables costs associated with conducting scientific experiments. This one is it's still research stage. Experimentation, investigations, those ones are just research activities, so we can't capitalize, not capitalize. And then license purchase to permit production and sale of a product for 10 years. This is the issue of license. We said a license is an intangible asset, so it should be capitalized. So simple, isn't it? So this is how you should track these questions. There are also issues to do with the disclosure requirements with regards to International Accounting Standard number 38, intangible assets. the following should be disclosed in the financial statements. When you are talking of disclosure, we are not talking of presenting information in the financial statement. We are referring to the notes, disclosure to notes, not to the financial statement. Okay, so this is disclosure. Let me just say in notes to the financial statements. All right. So what do we have to write in the notes? We need to write the amortization method used for the development expenditure, whether straight line or reducing balance, then the amount of amortization during the period, a reconciliation between the written down value brought forward and the value carried forward, the amount of research expenditure charged in the statement of profit or loss for the period, and then the position of each development project should be reviewed each year. If any project no longer meets the IAS 38 criteria, then it should be written off. Okay, so this was the lecture, ladies and gentlemen, dedicated to intangible assets. I hope you have enjoyed it, and if you haven't yet subscribed to the channel, please click on the subscribe button to this video, and also click the notification bell so that you'll be notified of any new videos that come that might help you remember or might help your friend. So let us just do the right thing and subscribe and share the videos. Until next time, may the good Lord continue to bless you forever and ever. Amen. I'm signing out.